Good afternoon, ladies and gentlemen, and welcome to this week's trade review session. And I was expecting these to be here, unfortunately, but let me just bring up the trading results for the week so far. As it stands, I have one trade open, the gold trade that you can see there in yellow. Slightly against me, fluctuating a lot in the last few hours, to be honest, between about 1960 down to about 1950, but seems stuck in that range. I don't have a stop on the trade at the moment, but if I do decide to carry the trade over the weekend, then I will put that in place. And equally so, I'll mark this trade to market. So at the moment, the market is about 1959. I'm short at 1950. So there's about 90 pips potentially that will come up off of that, which will still leave the profit for the week above about 566 pips, somewhere in that range. Hopefully that improves over the next few hours and I'm able to trade out of that at a slightly better level. Best week that we've had for a number of weeks, to be fair. And as you can see, when you look at the daily totals, it's been fairly standard, bar of course Wednesday, where it's been fairly consistent. Standard wasn't the right word. 135 pips up on Monday, 268 on Tuesday. Thursday 140 pips to the good, and today, taking into account the potential the remaining trade that exists there, gains of about 130 or 140 points today. The only losing day being Wednesday, where as you can see the moves in gold, where I bought gold and had to stop out around the 1910 level. And then equally so, as we rallied and pushed away as it did in fairly dramatic style, had to take a loss on the way up as well. So gold was the main cause for those losses on Wednesday. And when you look at the summary for the week, 73 trades in total. Again, one of the metrics that I always prefer to look at, the number of winning trades exceeding the losing trades. Gold, 31 trades, so a high percentage of trades in gold this week for a very small return. So definitely not relative to the amount of risk taken on in that particular commodity. Yesterday, the start of the Jackson Hole symposium. And obviously Jerome Powell's commentary yesterday in relation to how inflation is going to be treated going forward from this point, and the relaxation, if you like, of the targets and the degree of flexibility around the targets for inflation over the period. So a fairly strategic move away from what we've seen over the last 40 or 50 years. Very well received by the markets. Gold was extremely volatile, rallied all the way up to about 1970, fell away all the way back down to 1909. I was short gold as we got that spike, unfortunately stopped out on that for the loss of 200 points, and then a couple of Dow trades that went heavily against me during the earlier part of the day. But thankfully the trading both at the beginning of the day and at the end of the day still enabled me to return a profit of 140 pips on the day. But very, very volatile, supremely volatile in gold. We've seen a bit of that volatility continue in gold in the early part of today, but as I said, we're stuck in a bit of a range at this particular point. The Dow is selling off a little bit down to 28,460, which is fairly close to the low of the day so far to the day. DAX back trading just below that key 13,000 level, and gold around 1957. So moving back to my entry point at this particular point. If you're wondering why I look away from time to time, I have to look to a different screen today just to see the questions that are coming through, whilst I'm talking to you about the markets. There are a few things, and again, I know I like focusing on things that I've done wrong over the course of this week, and there's always one or two things that I can highlight. In terms of holding on to gold a little bit longer than I would normally today, in terms of the trades that we put on today, I suppose there's a number of ways that I look at it. Number one, I always look at it in the context of how the day, or how that particular day is going. And as I wrote very early this morning, I was up close to 200 points before 9 o'clock. So a couple of nice trades around and just prior to the opening of the European opening bell early this morning. So I was a little bit disappointed that I stopped out of the gold positions yesterday when it rallied up to 1970, and I didn't really want to go through the same process today. So on the back of having a decent profit this morning, I was happy to give the gold trades a little bit longer to try and turn around and see if they move back to the downside. We have seen some quite significant sell-offs in late trading over the last couple of weeks, and I'm kind of hoping for one of those over the next period. But like I say, reasonably happy to be short gold. The level's not a million miles away from where we're currently trading. And if I decide to run that trade over the weekend, then I don't think anybody will be particularly surprised. There's a few questions coming in which I will get to in a few minutes. There was something of note today as well, just with the opening trade around the opening bell in New York. So we've got the Dow Jones on the screen here, and we're going to just look at the trade that was done around this time. So I think I sold Dow futures around 28,586. So just looking at the time that occurred, it was slightly before the opening bell in New York, so probably 25 minutes before that if you look on Telegram and you look at the time that we did the trade. But quite a significant sell-off just in those first, and the period that I really do look at during the course of the opening bell is the first 7 minutes. And you do see some fairly significant moves during that period. I put a take profit in about 36 points away from the level that I traded. That was filled very, very quickly. I'll just put some crosshairs on here. So that was filled very, very quickly in this area, and then we continue to drop away and fall below 28,500, where we're and not a million miles from where we're currently trading at this point. So that trade has continued to work over the last couple of weeks. I think what I've had to do is reduce the take profit level to about 25 to 30 pips to make sure that I catch it. A couple of occasions we've seen a decent bounce away from those levels as well, and you have to be mindful of that. But the trade works or fails within that first 7 minutes. So between 2:30 UK time and 2:37. And if you are not out of the trade by 2:37, or if you haven't taken your profit by 2:37, then you need to make a decision about whether you're going to run that or cut that at that particular point. Thankfully, as I've mentioned already over the last couple of weeks, it's been a case of being out of that trade, but really reducing the amount of pips that we're looking for over it. But you can, I think today's graph, and albeit a 1 minute graph, is showing you quite extensively the amount of drop off that you can see from that opening bell as the different stocks start to open, and we see some fluctuation during that particular time. One of the questions that's coming through at the moment from John is just in relation to trade size and how you trade size. I think he's been in a situation where his size has fluctuated, and again, goes back to a few of the things that I've said over the last few weeks in terms of, you know, the very traditional way or academic way that some of the approaches to retail trading are taught. You know, I probably don't concur or agree with too many of them, and trade sizing is another way where there's a slight difference in the way that I approach it. We all have a number with which we start our account. For me, that is what my account size is. And the truly academic way that trade sizing is taught is that you're continually resizing based on a 2% or 3% level of your account balance. So as your account balance is changing, your trade size is trading, and that's okay if you can trade in very, very, very small sizes and make you know, make those minute differences. The way I prefer to look at it, and it's all about simplifying the approach to your trading, is to start with your starting balance effectively becomes your nominal account balance, and your trade size is determined from there. There's no point reassessing and reframing and changing it on a daily basis or even a weekly basis. Just keep your 3% trade at a certain size and make it very, very simple for yourself. Just trade in that size time and time again. It will obviously differ by product, or there will be slight differences by product, but keep your exposure at the same level. And regardless of whether you're making a lot of money or you're losing a little bit of money, don't worry about tinkering with it, and maybe reappraise it on a monthly basis. So my trade size is always the same. I think where some of my trading may be causing some issues for people who are taking a similar number of trades, is that it can become difficult if you're running 4 or 5 open positions at one time, because of the margin restrictions that are available, or that are constricting the number of positions that you can run at any one time. But I think there will be limitations to how many trades you can get on. But if you're, I think for a maximum trade size, you should be able to agree or determine what the standard number is that you should have as your trade size on a trade per trade basis. The margin requirements around the number of trades that you have on will unfortunately is not something that I can dictate based on the number of trades that I take on. If you want to work out a way that you can take part in every single trade, you're obviously going to have to trade in a little bit smaller size across the board, but hopefully that makes sense. But I try to keep my trade size fairly standard. Every trade for me is a 3% trade. The only time that I potentially differentiate or move away from that is around the opening bell in New York. Good level of success over the last number of months with that opening trade, and I will go up to 5% on that particular order. So just around that. The other thing that I wanted to talk about, just again in relation to my own mistakes over yesterday in particular. So we're looking here. I'm just going to widen this out a little bit to and I might take it down to a minute chart even. So we just looking at yesterday's movement. So we're going back to the so we're just looking for the movement that occurred around the speech that Jerome Powell was giving yesterday, and we can see the majority of it coming in around here. So a bit of a rally to the upside. You can see the movement, sorry, this is the move. So we saw the movement up here to about 1970. and then we've fallen away from that level on a couple of occasions, a bounce back up as Jerome Powell starts talking, and that significant move to the downside. The one thing, if you are going to trade either around a number or around the significant event that's occurring in the market, what I like to say to people is to let the move happen and then trade. What I did yesterday in selling at 1951, selling again at 1959, was pre the movement. And had I allowed the move to happen and then start to slow down and then entered a couple of sell orders, I could have taken part in all of the movement to the downside that then followed. I think we're going to see that better on some of these charts. Sorry, the movement was there. So just looking at a few of the other questions that are coming through. Trade size has appeared of a couple of occasions. Some people are asking what I expect for gold from these levels. As you'll know, over the last number of weeks, my preference has always been to approach gold from the short side. I don't really see any reason to change that. Obviously, Jerome Powell has made his announcements now in relation to inflation. That's affected gold. It's affected the bond markets and has had a positive effect on the indices, as we see an approach that's certainly going to favour economic growth over controlling inflation in the over the next period of time. So I expect gold to stay. I think we have a ceiling on gold for the foreseeable future. So I will continue to trade that from the short side. The euro dollar, there's been dollar weakness again against both the euro and sterling over the last couple of days. And above 119 again, I think the euro is definitely priming itself for a sell. The equity markets obviously are trading. The Dow is now approaching record levels and following the S&P 500 and Nasdaq well, it's not going to follow quite as often as they have to their record closes, but there are we are certainly now within sight of the record levels that we saw back in February, whereas the Dow hasn't been close to those since the pandemic first hit us. Coronavirus seems to be taking on less and less of an impact on the market. Saw Donald Trump again this morning talking out the prospects of a vaccine over the course of this year. It's a very fluid situation. I just think with the run-up that we've seen specifically or more significantly in the Nasdaq and the S&P over the last period, that a correction has to be on the card. Just getting the timing of that correction right is going to be the key issue over the next period. So I'll leave you there. The 20 minutes or so is over. Like I say, it's been a good week. Over 550 pips worth of profit, potentially a little bit more than that, and another positive week, which I'm certainly not complaining